Hi everyone. So this is the last part of our discussion on partnership dissolution. This is now about withdrawal, retirement, death, and capacity of the partner. Now, in our previous discussion, what we had focused was admission of partner, and that would increase the number of partners. No? Now, in this case, there is now a change in the capital structure where there will now be a decrease in the number of partners. So here, our first topic will be on withdrawal and retirement of a partner. There is a change in the capital structure by withdrawal or retirement of a partner. So the partnership may allow any of the partners to withdraw or retire in the firm. The business may continue after such withdrawal. That is what we have emphasized before, no? It does not necessarily mean that if there is a change in the structure, we will put a stop on the operation of the business. So, on the other hand, it says here that the interest of the retiring partner may be, we have three possible situations here. It can be sold to a new partner, it can be sold to the remaining partner, or it can be sold to the partnership. So actually, this first situation wherein the retiring partner is selling his interest to a new partner, it's just like admission of a new partner, no? Admission by purchase. So our entry there, if you can still remember, is to debit the selling partner's capital and to credit the buying partner's capital. So in this case, who is the seller? The seller is the retiree or withdrawing partner, and the buyer is the new partner that is to be admitted. Now, the other one, in terms of entry, it's just the same as the first one. You debit one capital and you credit another capital. In the first case, you debit the withdrawing partner's capital and credit the new partner's capital. Here, on the second case, you debit again the withdrawing partner's capital and credit the continuing partner's capital. Now, in number three, when you sell or the retiring partner sells interest to the partnership, it's just simply, it's not just simply transferring the capital account, no? There will now be payment that is to be given to the partnership to the retiring partner. In the first two, the payment is a personal transaction between the retiring and the new partner or the continuing partner. So that means the payment cannot be reflected or will not be reflected in the partnership book. But here, if the partnership is the one who is buying the interest of the retiring partner, definitely the asset of the partnership will decrease. So our pro forma entry here in the first and in the last situation is debit the retiring partner's capital and credit asset, whatever is the amount to be paid. So let's start with the sale of interest to a new partner. So with the consent of the remaining partner, of course, we need this, whatever is the change in the structure, there should be the consent of all partners. So here, you need the consent of the remaining partners. So the retiring partner may sell his interest to an outsider. You cannot complete a new partner without the consent of all. No? The sale of interest is recorded in the same manner as the admission of a new partner by purchase. The partnership recognizes only the transfer of capital interest from the returning partner to the new partner. So any gain or loss, again, is either a personal gain or loss of the retiring partner. Now, if we're selling the interest of continuing partner, so the interest of the retiring may be acquired by any of the continuing partner, and the transaction is recorded in the same manner as the sale of interest on the partner. Partnership recognizes only the transfer of interest from the retiring, so debit the retiring partner's capital, and credit the acquiring partner's capital. So acquiring is any of those remaining partners. No? Now, sale of interest to the partnership. So, as I said a while ago, it's not just simply transfer of interest, but rather we have to recognize the payment. A retiring partner may sell his capital interest to the continuing partner through the partnership. The partnership has the obligation to make payments to the retiring partner either by one, payment in cash, two, transfer of non-cash assets, or recognition of liability for the full or the balance of the unpaid interest of the retiring partner. So that means if the partnership will not immediately pay the retiring partner, then a liability can be recognized. Now, the purchase price, of course, that is to be paid by the partnership to the retiring partner may be equal to his retiring partner's interest. It may also be less than, or it can be more than. Actually, if you try to analyze this, ito yung kabaliktaran ng admission by investment. Admission by investment, we debit the asset invested and credit the capital of the new partner. Dito baliktad, you debit the retiring partner's capital and you credit the asset. Huh? Okay, when the payment of the retiring partner is less than or more than the capital or interest, the difference between the purchase price and the capital interest may be accounted for using one bonus method and the other one asset revaluation method. So para pa rin admission by investment. Diba? Kung natatandaan yun, we have these two methods when we admit a new partner by investment. Now, accounting problems involved in the retirement of a partner. So, the following are the accounting problems involved in determining the capital interest of the retiring partner. So, basically, you have to make an adjustment first on the capital balance of the retiring partner, no? So, the capital balance of the retiring partner must be adjusted as of the retirement date to be used as the basis for settlement. So that means if, for example, the accounting period starts on January 1 and a partner retires on May 1, that means you have to adjust his capital from the beginning balance of January 1 up to May 1. So to be taken into consideration here will be asset revaluation and the profit distribution. If you still recall in the admission by investment, we have to adjust the capital of the partner by considering any profit or any asset revaluation from, in this case, January 1 to May 1. So of course, revaluation will affect all the partners, not just the retiring partner, no? That will be to be fair to all. Now, for practicality, only the capital of the retiring partner may be updated for the profit or loss share through estimation. Kasi medyo mahirap naman na pag may umalis na partner, i-account mo lahat, no? Yung actual. So, para ka na rin nagsara ng libro ng business. So, what we can simply use is estimate. Of course, this will be depending on the agreement of the partners, no? Now, the drawing account of the retiring partner must also be closed against the capital. So how do we calculate the retiring partner's interest? How do we adjust it? What are the things we have to consider? So, of course, this is the beginning balance, no? From the beginning balance, or that is the, let's say, January 1 balance. You have to subtract any withdrawal from January 1 to May 1. You have to add any share in profit if the result was supposed to be a profit. That is to the date of the retirement, or subtract if it was a loss. And then you can also add loans and advances to the partnership. Ibig sabihin kung may utang ang partnership sa kanya, idagdag mo yung loans na yun. Now, may loan payable ang partnership to that partner. Or subtract if the loans and advances is from the partnership. This means ang may utang yung retiring partner. So we have to subtract that loan. No? Another one is there is a revaluation. If it's a positive asset revaluation, then you have to add. But if it is a negative asset revaluation, you have to deduct. And that now, after considering all of this, will give us the adjusted interest of the retiring partner, which is upon retirement. Now, let's have an example here. So we have the statement of financial position of Adore, Bell, and Carlos. So here are the cash and other assets, and then liability, and then the capital. So take note, capital nila, 400, 500, and 300. Now, the partnership profits